Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special housing report. Today we look at what's happening with mortgage rates. There's been plenty of action in the last week or so on fixed mortgage rates in New Zealand. What's going on here and what happens next? Well, back on April the 26th, Kiwibank announced a one-year special rate of 4.99%. And that really put the cat amongst the pigeons in the mortgage market. And it's done very well for Kiwibank. They say they've pulled in $100 million worth of new business. And this obviously is at the expense of the big four Australian-owned banks. And last Wednesday, ANZ and National, they're together, remember, announced a new one-year fixed rate of 5.25%. That was last Wednesday, and that really has sparked up activity in the sector. Over the weekend, BNZ matched that rate, cutting its 1 year to 5.25%, and BNZ announced a special 18-month rate of 5.1%, so that's even lower. And today, this afternoon, TSB has cut its 1 year rate to 5.2%, so that's slightly below the big four on 5.25%, although ASB hasn't quite got there yet. It may well move shortly. Its 1 year is at 5.7%. So are we seeing a new mortgage war? Some of those old enough to be around in 2004 and 2006 will remember the real mortgage war that went on. BNZ launched its Unbeatable campaign and in a series of pretty dramatic moves cut its 2 year rate. ASB was chasing hard, and that helped spur on the housing market at that time and frustrate the Reserve Bank, which was trying to slow down the economy. So are we seeing a return to the mortgage wars of 2004 and 2006? And will this do the same thing again to the housing market and to the economy? Well, there are a few things that are a bit different this time around. Firstly, last time around, most people were on fixed mortgages, and back then fixed mortgage rates were much lower than floating rates, and people were used to doing fixed deals. Much more than 50% of mortgages were on fixed rates, and people tended to get used to the routine of every 18 months, 2 years or so, moving to a new fixed rate. Things are a bit different now. Most people now, more than 62%, are on floating rates. And for the last 2 to 3 years, the floating rate has been as cheap, if not cheaper, than the fixed rate. However, in the last couple of weeks, we've seen some of these fixed rates, particularly the 1 year rates, being advertised below the advertised floating rate. And it's causing some people wonder, maybe this fixed rate's a great deal, I should have switched from floating to fixed. Well, it all depends on your view on what's happening with interest rates. And it's interesting, in the last couple of weeks, there's been quite a change in the view of international financial markets and, of course, wholesale markets here in New Zealand on what's happening with interest rates. And that's been a factor in these pretty hot-looking fixed mortgage rate deals that the banks have been offering. That's because globally the outlook for economic recovery has worsened. And the European financial crisis has really started to come back into the spotlight. The problems in Greece, the change of government in France, has got people thinking maybe the solution to the European crisis we'd all sort of been convinced about for the last 6 months or so, maybe that's not working. And certainly the economic growth story coming through from the likes of America and China has been much weaker than expected. Also, growth in New Zealand has been weaker than expected, and we saw some pretty ugly-looking unemployment figures a couple of weeks ago. This means that people in the financial markets now actually think that the official cash rate, which is currently at 2.5%, may actually be cut further come June or maybe even September. Now, financial markets are a bit different from economists. Financial markets, lots of foreign exchange traders and interest rate traders tend to be quite flighty, whereas economists still don't think there will be a cut in the official cash rate on the whole. They're still expecting December or maybe even a March increase in the official cash rate. So what does this all mean then to what's happening with mortgage rates? Remember that fixed mortgage rates tend to be based on what's happening in the wholesale interest rates, what we call the swaps markets. So let's have a look now at what's happening in those swaps markets, those wholesale interest rate markets, and also what's happening with mortgage rates. So firstly, let's have a look at the swaps rates here, and you can see this at the bottom of the article that this video is on, and you can play with it a bit to see what's happened. And this goes back to 2010, those people who were on fixed rates then, when interest rates were quite a bit higher, will remember that as interest rates fell, some of them had to try and break out of those fixed rates, and that was quite painful. And you can see here that the 2-year swap rate, which is what the 2-year rates are based on, has been sort of flat through most of 2011, then dropped away through the end of 2011 when the European crisis came on board. Picked up a bit at the beginning of the year, and there were some people saying now's the time to fix, interest rates are about to bounce up. Well, certainly in the last month or so we've seen the 2-year fixed rate drop down to a low of about 2.5%. Remember, the official cash rate right now is at 2.5%. That essentially says the official cash rate's going to stay there for 2 years. It's bounced up a bit in the last few days, but essentially we've seen it drop from 3.2% or so to 2.5% or so in the last month, and that's helped power those cuts in fixed mortgage rates from the banks. And you can see the same here with the 1-year fixed rate up from 2.9 or so down to a low of 2.4 or so in the last month or so, and that's helped fuel these cuts from Kiwibank and the rest. The question is, what happens now to the official cash rate, and should you fix or should you float? Well, tough question, because it really brings into play your views on what you think interest rates are going to do for the next couple of years, and how much of an appetite for risk do you have. Now, if you think that the economy is a wonderful place, that things are going to bounce back in a hurry, that all those gloomsters like me are wrong, and that we're going to bounce back in a hurry, that means you think interest rates are going to rise, and probably a little bit more than the market's expecting and a little bit faster. If you think that, you're probably better off fixing, because there's some pretty good fixed rate deals at the moment. And if you think interest rates are going to bounce higher, then you're better off fixing for a year or two. If you think the economy is pretty subdued and interest rates stay low and may even fall lower for much longer, then floating looks more attractive. And certainly for the last couple of years, there have been quite a few people saying, now's the time to fix, now's the time to fix, interest rates are about to bounce, and then they never do. Then maybe you'd stay floating. My personal view is that interest rates are likely to stay lower for longer, that the global economy is in quite a bit of trouble, and when that happens, interest rates tend to be repressed by central banks, and certainly inflation doesn't seem to be a problem at the moment. That means that the outlook for interest rates is for lower for longer, if you believe that the economy is in a tough position and that we certainly haven't fixed the problems of 3 to 4 years ago. So there we have it, the current view on where fixed mortgage rates are at, what may happen or not with the official cash rate, whether you should fix or you should float, and whether we're in for another one of these 2004-2006 mortgage wars which sparks up the housing market. The Reserve Bank doesn't think this is likely to spark up the housing market. It says that affordability is still pretty tough for a lot of people. They're in a lot of debt and they're going to struggle to put on a lot of debt and push up those house prices. Interesting to see whether that happens. Certainly we're seeing some signs of pretty hot looking activity in some parts of Auckland. The question is, will it spread? Remember though, between 2002 and 2007 prices doubled. It will be very difficult for that to happen again, given the state of incomes and the amount of debt now in the household sector. I'm Bernard Hickey. That was a special housing report from interest.co.nz.